Have you ever experienced the frustration of entering what seemed like a perfect trade, watching your floating profit swell on the screen, and then, as if the market knew your stop, seeing those gains vanish and your position reverse? You exit flat or even at a loss, only to witness the price resume its original direction, mocking your decision. This painful cycle isn't about your entry, it's about your exit. The stark reality is that most traders allocate roughly 80% of their research and preparation to timing entries, honing indicators, drawing support and resistance levels, and seeking that elusive perfect setup, while leaving the critical exit decision to just 20% of their intuition, often driven by fleeting emotions. But the exit is not an afterthought, it is the linchpin of trading performance. Today, I will share the hard-won lessons from my own trading journey, the 4 fundamental exit logics that I rely on, the specific scenarios where each excels, and, crucially, how to combine them so that your equity curve stops resembling a stomach-churning roller coaster. By the end, you will recognize that the exit is not merely a side note, it is the most valuable component of your entire trading system, capable of transforming a mediocre strategy into a robust one. Let's examine why exits are inherently more challenging than entries, starting with a fundamental observation. Many traders devote up to 90% of their energy to perfecting entry signals, believing that a well-timed entry guarantees profitability. However, a candid review of any trading journal reveals that the largest drawdowns often stem not from poor entries but from 2 exit-related failures, either holding on when the trade has clearly turned against you, or exiting prematurely when you should have stayed. The reason exiting is so difficult lies in the psychological state shift. When you enter a trade, you are typically calm, objective, and analytical, able to weigh probabilities without emotional interference. But once capital is committed and the position is live, your emotional landscape changes dramatically. Profits trigger greed and a fear of giving them back, while losses activate fear and hope that the market will reverse. These emotions cloud judgment, leading to impulsive decisions that sabotage a well-conceived plan. The core purpose of any exit strategy is to safeguard 2 precious assets, the profits you have already accumulated and the very survival of your trading account. To achieve this, I categorize exit methodologies into 4 distinct types: target price exits, trailing stop exits, time-based exits, and signal reversal exits. Each is suited to a different trading style, and deploying the wrong one for your strategy can turn a winning edge into a losing system. Let's examine a chart that illustrates the relative profit capture efficiency of the 4 exit methods during a trending market. In this scenario, a target price exit typically captures only about 60% of the total move. Why? Because exiting at a predetermined profit target means you deliberately leave the trade early, foregoing the continuation in exchange for certainty and a higher win rate. In contrast, a trailing stop exit captures the vast majority of the trend, often over 85%, because it remains attached to price action, letting winners run until a specified retracement occurs, thereby participating in the bulk of the move while giving back a portion at the end. A time stop exit can be highly unstable. Since it is triggered solely by the passage of a fixed interval, it may force an exit in the middle of a developing trend, causing you to miss substantial gains. Finally, a signal reversal exit tends to capture around 75% of the move, but it suffers from significant profit giveback because it waits for a clear opposite signal before closing, effectively allocating a large part of the trend to the other side. These differences underscore that no single exit method is universally perfect. The optimal choice depends on the prevailing market regime. True experts often blend 2 or more exit logics to create a more resilient approach. In practice, successful trading rarely relies on a single exit method. Instead, it involves the strategic combination of 2 or more logics to balance profit capture and risk control. Here are 4 classic pairings. First, 4 mean reversion strategies. Combine a target price with a time stop. The profit potential from mean reversion is inherently limited. If you don't exit when price returns to the mean, it may promptly diverge again, erasing your gain. Meanwhile, a time stop prevents capital from being tied up indefinitely if the expected reversion does not materialize within a reasonable window. For example, in a pairs trade where you buy the underperformer and sell the outperformer with the expectation that the spread will revert to its moving average, you set a target at that average but also exit after 5 days if the spread has not contracted. Second, for trend-following strategies, pair a trailing stop with a signal reversal. The trailing stop locks in profits as the trend progresses, while the signal reversal acts as a final defensive layer. Early in the trend, keep the trailing stop wide to avoid being shaken out, and tighten it as the trend accelerates to protect gains. For instance, if a moving average crossover system signals a long entry, you might trail a stop at 2 times the average true range, but you also exit if the moving averages cross back against you. Third, for event-driven strategies, combine a time stop with a target price. These trades are highly time-sensitive. If the expected catalyst does not produce a move within your predefined window, you exit to free capital. Similarly, if the price reaches your target, you exit because event-driven sentiment often fades quickly. Fourth, for arbitrage strategies, combine a target price with a hard stop. Exit when the spread returns to its fair value target, but set an unconditional hard stop if the spread diverges beyond, say, 3 standard deviations, protecting against the risk of a broken deal. This chart demonstrates how the same entry strategy can generate dramatically different equity curves simply by altering the exit combination. When relying exclusively on a target price exit, the equity curve appears steady but climbs slowly. This is because you are consistently banking small, predetermined wins, but you systematically miss the large trending moves that generate outsized returns. The strategy is comfortable psychologically but leaves substantial profit on the table. Adding a trailing stop exit lifts the equity curve noticeably, as the trailing mechanism allows positions to remain open during sustained trends, capturing far more of the move while still providing downside protection. This transforms the return profile from a grind to a more dynamic growth path. Alternatively, incorporating a time stop exit improves the curve modestly by cutting dead positions early, thereby freeing up capital that would otherwise be languishing in unsuccessful trades. The key lesson is that the impact of your exit methodology on final returns can surpass even the quality of your entry signals. Backtesting your own strategy with different exit rules is an invaluable exercise. It often reveals that a simple change in exits can elevate a mediocre system into a profitable one. Let's now address the psychological forces that sabotage even the most well-designed exit plans, because the biggest obstacle is often your own mind. The first trap is anchoring. When you enter a trade, your entry price becomes a powerful mental reference point. While in profit, you think, it's not enough yet compared to my entry, so you hold on. When losing, you think, I'll wait until it gets back to break even. The predictable outcome, profits dwindle into losses, and small losses balloon into large ones. The solution is to immediately forget your entry price after executing and focus exclusively on the current price relationship to your predefined exit rules. The second trap is loss aversion. People experience the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. So, when a floating profit begins to give back even a small amount, the emotional sting can prompt a premature exit, causing you to miss the major move. The fix is to define in your trading plan the acceptable amount of profit giveback and treat it as a necessary business expense. The third trap is the disposition effect, the tendency to sell winning positions too quickly to lock in gains while holding losing positions too long in hopes of a recovery. This behavior is deeply human but antithetical to trading. The remedy is to deliberately do the opposite, let profits run and cut losses short. The fourth trap is regret aversion. After a premature exit, you might fear re-entering because you already missed the move. Or after a stop that got hit and then the market reversed, you might be afraid to use stops again, leading to catastrophic losses. Each mistake leaves an emotional scar. The solution is to accept that missed moves and false stops are an integral part of any strategy. Much like a restaurant occasionally burns a dish, you don't stop cooking. The exit isn't a side note, it's as important as the entry, maybe more. For exit logics, target price for mean reversion, trailing stop for trends, time stop for event-driven, signal reversal as the ultimate defense. Combine them, trend equals trailing plus signal reversal, mean reversion equals target plus time stop. The biggest enemy is psychology, anchoring, loss aversion, disposition effect, regret aversion. Control your mind before your hands. Trading isn't about who enters better, it's about who exits better. Master your exits, and your account will thank you. Today, we have covered the 4 essential exit logics: target price, trailing stop, time stop, and signal reversal, along with 4 classic combinations that real traders use to build robust systems. You don't need to completely overhaul your approach immediately. Instead, start with one powerful exercise. Take your last 20 closed trades and imagine applying a different exit method to each. If your system currently uses target prices, mentally substitute a trailing stop and note whether you would have captured more profit from the winners. If you typically hold until a signal reversal, consider adding a time stop to see if it would have reduced the losses on trades that meandered sideways before reversing against you. After running this analysis, share your discoveries in the comments. You might find, as many do, that your entry strategy was not the problem, your exit methodology was the hidden culprit. Thank you for watching, and I'll see you in the next session. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.